Jacksonville, Florida, but I'm also licensed in Virginia, North Carolina, and Georgia, since we're right on the border.
Hello.
Yeah, so excited to get started.
All right. Yes. Well, let's go ahead and get started. Horace, how are we looking? He's probably pulling in.
Yeah,
We're
I'm
getting there.
trying
We're
to.
getting there. It's
there
loading.
you
It's loading. Okay. Okay. He's working on trying to go live. If you're there at the office, maybe you can go inside and use their Wi-Fi
go.
if that'll help out any. It's 12:04. So, do you have anyone on your live right now, Carly? I don't want to hold anybody up.
There's one person.
Okay.
Hmm.
He's working on. Okay.
Okay, you're live.
Okay, great, great, great. All righty, guys. So once again, we just got the live up and running. So another introduction real quick for those of you that just joined us. I am Keneshia Haye, your Jacksonville Dream Home Specialist. I'm a licensed real estate broker here in Jacksonville, and I'm here with Carly McLeod. Go ahead,
Hello,
Carly.
guys. I am also a local mortgage loan officer. So Kanishi finds you the home, I get you the money. That's how this works. Make it real easy.
It's just that easy.
Yeah.
And saying that, Carly, it's so funny. I'm at a closing today, a walkthrough in a closing today, and it was a crowd. I always ask my buyers, so how was the process for you? Was it the experience that you were thinking? And he said, it's definitely not what everybody else was saying. You
Hmm.
know, and that's the point I want to make in doing these videos and bringing the awareness to people. Like, listen, I know mama purchased, papa purchased, your cousin, your friend purchased. Their experience is their experience. Let your experience be your experience, because unless they're using the same agent, buying the same house at the same exact time, the experience is going to be different.
Right.
For instance, Carly, we're looking at interest rates go down right now.
I'll talk about
Right?
that. Hmm.
Exactly. So if your friend purchased 2 months ago, their interest rate is going to be very different than what your interest rate is going to be today and then a few weeks from
Right.
now, right? So
That's right.
let your experience be your experiences. One nugget that I would love for anyone to take away from
Right.
this class that we're doing, right? And I don't know if anyone want to say anything or write anything in the comment. But what is your biggest thing that you want to learn today? What is the biggest takeaway that you want to take away from today? What are some obstacles that you may have heard, or some myths that you've heard? Like, for instance, the number one thing that you always hear is that your credit has to be superb and perfect. And you got to have like a savings account that's like a rock star. And that is so far from the truth.
Hmm.
My guy today, he actually got back $1,900. So he put in his binder and he was actually able to get money back at closing. So a lot of times we have this misconstrued notion that I need to have a bag of money, and that's not true.
Hmm.
Go on to the next one for me, Carly, please. Right. And I understand purchasing is an exciting time and it should not be stressful. Guys, I do not deal well with stress. Let me tell you, I do not.
Yes, you do. Yes, you do. Yes, you do. I will contest that. That's not true.
I try to be as less stressed as
Uh-huh.
possible. Although I can deal with it, I don't like it. Right?
We're the ducks above water, right? The ducks look calm above water, and then underwater, it's the kick, kick, kick. Yes.
That going on, right?
That's our life. Yep.
So if we can prohibit ourselves from even going through that turmoil,
Hmm.
Carly and I have been doing this long enough that,
Uh-huh.
we can possibly see some of the pitfalls before they get there.
Yes.
So therefore, we proactively work with you guys to try to make sure that we do not have these pitfalls at the end. So what
Hmm.
I like to tell people is there's a difference between pre-qualification and pre-approval, a big difference. And Carly will go in further on the difference with those two.
Yeah.
And this is why I love working with Carly, because Carly does the pre-approval. Therefore, my clients aren't pulling their hairs out at the end of the transaction.
Right.
We actually get to do the walkthroughs in joy and in good spirit, because they know without a shadow of doubt they had a great experience.
Yeah.
They weren't at the end and the underwriter is asking for crazy things that they should have
Right.
asked for earlier in the transaction.
Mhm.
So guys, that is why I like the pre-approval. So you don't have that guesswork at the end. Okay. And then once the time we get together and we get that pre-approval and I have that number, I'll go ahead and look for those houses for you. That's your fun time. You're supposed to
Right.
be excited looking for this house that you're going to spend many of years in with your family, possibly growing a new family. So I
Mhm.
want that experience to be great for you. And once we find that house for you guys, we're going to go ahead and make that offer. Now, what I like to tell people is I like to look at the offer as a whole for you, not just the number. So we will do what's called a market analysis to see what have sold recently in the area. It's a process that the appraiser also uses, something similar to that, using recently sold homes in the area to get to an appraised value. But I'm not a licensed appraiser, so I get to an estimate, right? A number that we should go in as an offer amount. But guys, like I say, as an overall offer, we're going to look at how many days would you need for inspection period? Do you need 10 days? Do you need 15 days, right? Closing date. We'll definitely get with your lender, and depending on how your file looks, whether or not we can do maybe a 15-day closing, or do we need to do a 30-day, or do we need a 45-day closing? And all of these will bear a burden on how your offer is accepted by the seller. Because let's say it's a seller that needs to get out there right away and you're like, hey, but I need 45, I need 60 days. Your offer may not be appeasing to them, although you're offering a full price offer. You understand what I'm saying? So that's why I'm saying maybe it's not always the price, and it is some other terms in that offer. So we'll write that offer up to get you in that house, right? So once we have that offer sent out and you and the seller go ahead and negotiate that offer, once it's accepted, then guys, we'll move on to the next phase, which is your inspection phases. Because I will always let you know, hey guys, get a home inspection done. You've never lived in this house before. You do not know any defaults that's in the walls, the electrical, the plumbing, any of that. Allow a licensed inspector to come out and get those items inspected for you. And you say, okay, who pays for that? Great question. That is a cost of yours, because guess why? You do not want the seller to go ahead and hire their inspector. Then nothing is wrong with the house. Nothing is wrong with it. So
Right.
you go ahead and you hire your home inspector, that they work for you. They represent you. Therefore, anything that's wrong with the house, they have no problem with reporting that to you, because they are representing you, right? So from there, once we go ahead and get that home inspected, everything is good with that, then we'll go ahead and say, hey, Carly, the house is good to go. Go ahead and order that appraisal for me, right? And that's the appraiser will come out and check the value of that home, right? And like I say, one of the gestures that they use is they go to the recently sold homes, the previously sold homes in that area, as well as they're going to look at, is these homes compatible or comparable to this house that is being purchased, meaning bedroom sizes, square feet. Has it just been recently renovated? Because this house is a recently renovated house. So they look for comparable homes to come to their value with, right? And guys, what I like to let you know is you do have in transaction fees to think about and consider when you're purchasing. So what does that look like? For instance, that inspection window, right? The inspection period that you're going to be doing, you want to hire your licensed inspector, right? And I've seen them range in between $350 to about $550, depending on the types of insurance inspections, forgive me, that you want to get done, right? Then you have the appraisal fee. I've seen that range between $400 to $600 as well, just depending on the size of the house or the appraisal that they use, right? And then also another in transaction fee is called the binder, or you've heard of the earnest money, right? But here in Florida, we call it the binder fee. And so from there, that's about typically $1,000 I've seen, or 1% of the sales price, right? And all of this is negotiable. Well, the earnest money is negotiable. The inspections, kind of negotiable. That'll be depending on you and the inspector. The appraisal is pretty much what it is, whatever the appraisal fee is, what they charge to go out. But definitely the earnest money or the binder is negotiable. But what I've seen in this area is traditionally about $1,000 is what you're going to pay for the binder fee, right? Now, those transaction fees, one of them, which is the appraisal, sometimes your lender can allow you to get that paid at closing. That can be one of the closing cost fees. Once we go ahead and we negotiate that with the sellers and see whatever the closing cost fees are going to be, perhaps you and your lender can have a conversation and see if that appraisal fee can be taken out of the closing cost fee. And I've also seen where you can ask your inspector if you can pay for that inspection at closing as well. And then guess what? If you have surplus of closing cost fees, perhaps you may be able to have that rolled into that as well. So that will be a great conversation, because that'll be case by case scenario. Not everybody will fit into that box of, hey, let's pay this at closing. But that definitely is a conversation we can have all collectively. Okay. And once the house gets appraised, if it appraises at value, kudos. We are moving to the closing table, guys. Now, if it does not appraise at value, okay, heart does not stop beating. We just go back to the negotiating window with the sellers, right? And we can go to them and say, hey, seller, we went in at 250. However, it appraised at 245. Do you mind dropping the price to the 245? I've seen them drop it. However, you have those that say, hey, well, I've done X, Y, and Z. I'm giving you this closing cost amount, and I'm doing this and I'm doing that. I've done these repairs. How about you bring the 2,500 and I bring 2,500, the gap money, and we seal it right there at the 250. Right. Or you have the opportunity to walk away from the transaction, say, hey, yeah, he doesn't want to come down to the 245, 5,000 is just that money that I just cannot come to the table with. So therefore, we're just going to terminate and receive our binder money back. You do have that option. But let's say we go ahead and we move on to the closing table, guys. The title company and the lender, they'll get together. What's that? What you guys call? You get your numbers together and all that.
Balancing.
Yes, that's it right there, Carly. Mine went blank. So they'll balance those numbers together for you. Your lender will get with you and talk with you about your CD, which is the closing disclosure. They would have already sent you that 3 days in advance, 3 business days in advance, and you talk about it, talk about your numbers, make sure you're understanding what your monthly payments will be and what fees are what. And then from there, when we get to the closing table, guys, a lot of these documents you've already seen, right? They're just needing a wet signature on there. So like your closing disclosure, you and your lender would have already discussed that already. You're just re-seeing it because you need to wet sign it. You're going to see your deed. You're going to see some different documents there that says, if you do not pay this mortgage, we're coming to take this house from you. You're going to see that over and over. And if you've recently gotten married or separated or anything like that, and your ID is different, your identification is different, update that to whatever our contracts is, whatever we went on the contract is, that has to match what your identification is. So if you're recently married, please update that, because when we get to that closing table, it's going to be too late. And they will stop closing. Closing will be stopped and held up because we got to make sure that you are the same person. All right. And then once you close, you sign your documents, guys, you get your keys, and that's it. Literally, that's it. Right, from start to finish, how to purchase a house. Now, Carly gonna come in here and give y'all these numbers on money.
Yeah, okay, so we'll keep talking. So I think an important thing to note with all of the out-of-pocket stuff that we talked about is that almost all of these costs are deducted from your total closing costs. So if I say your total closing costs are going to be $15,000, keep in mind that deposit and that appraisal are both taken from that cost. So it would be $15,000 less your deposit, less the cost of the appraisal. The only thing that is not deducted is the inspections, because technically we don't require an inspection on a home, but we definitely recommend it, because I always use the example of the girl that I worked with that went under contract on a new home, did her inspections and found out that she had something like $15,000 to $20,000 worth of foundation work that the home required. And had she not done the inspection and gotten in the home, there is a 5-figure bill sitting waiting on you that you didn't know you had. And you may be okay with that. It's not to say if you find something in inspection, it's fatal to the deal.
Exactly.
It would just be going back, you and Keneshia are now back in the negotiation window. Hey, can we drop this price by the cost of this? Can this be done before closing? Things like that are questions that then you would have to have answered that you wouldn't have to come out of pocket for, more than likely, because Keneshia can negotiate that for you. So big things to keep in mind. Also, I wanted to touch really quickly because I know in the news recently is this whole interest rate thing that happened this week. So really quickly, let me tell you in very simple terms what we're seeing. So it has been 4 years since the Fed cut federal interest rates. So that's what they cut. They did not cut directly mortgage interest rates. They don't have the power to do that. But what that means is that the federal interest rate is the rate at which banks borrow money. So basically, the Fed can say what that rate is, and then obviously that rate gets passed on to consumers in various different ways, affects different things. And as of Wednesday, when that happened, we had already forecasted that. Everybody already predicted that. So by Wednesday, that was actually already forecasted and priced into any active pricing. So if you did a pre-qual, say on Monday or maybe last week, that pricing was already kind of baked in. So on Wednesday specifically, you didn't see that rate drop, but in general, it's going that direction. And the good news is that's supposed to be the first of several cuts. So by the end of the year, they're expecting 2 more cuts, possibly. Not promised. Obviously, we never know 100% what's going to happen, but we expect another cut in November and then a further cut in December. And there may be, I don't know what the forecast is yet into 2025, which is wild to say that number out loud.
And we already there.
Right? I can't, it's like 2024 was just like, but it's good news. We're trending in the right direction. Even if day to day we kind of do this thing, it's this thing on the way down. So you might see ebbs and flows coming here or there. But that's the good news. So we really think that it's the time to get in the market because we want to get in there and start competing before we have everybody and their mom that's going to enter in together. So let's keep going here. So we've kind of already talked about a lot of this. These are the basically the things that I'm going to discuss really quickly here. So, equity is a huge thing, and I hear that term, thrown around a lot. So I want to make sure that people know what it means. So equity is basically the value that you have in your home. It's basically the difference of what is your home worth and what do you owe on it? So if your home is worth $400,000 and you only owe 200, for example, you have $200,000 worth of equity in the home. That's your money. That you own the home, that is your money. You can do things like pulling that out in a home equity loan, things like that. And this is the way that you build wealth in this country. It just is. You know, homes are assets that very, very rarely depreciate. They only go up in value for the most part. Even if they go down temporarily, it's going back up. So it's a great thing to have for you. And it's as opposed to renting every month when you pay your mortgage, that is your money to keep. So it's not just throwing it away. It's not throwing it in the garbage. It's not paying your landlord's mortgage. It's paying your mortgage and staying in your pocket. So that's an important distinction to make. And you can build equity, obviously, by paying down your mortgage every month. You pay a little bit of that goes to the principal of your home. And that's yours to keep. But your home can also grow in equity as it just goes up in value. So you have your home for 5 or 10 years, the value that it was appraised at when you bought it versus what it will be in 10 years are likely to be 2 very different numbers. And that's not anything that you do. You just get the benefit of that equity. So it's amazing. When you go to sell it, you get that equity.
Yeah.
So something to keep in mind. So this is just a quick graph to show, you know, the average equity in a home. And here in Florida, you know, we're in that 20,000+ category here. So that's awesome. But even all along the East Coast where I'm licensed, you know, everything looks good. Yeah. So when you come to me, again, I'm the person that does the financing. I'm going to be looking at your finances and seeing what you can and can't afford and what we can do. So a lot of these things are questions that I'm going to answer for you. How much can you afford? How much money do you need to put down? We're going to talk about how long you're living there. We're going to talk about the documentation I'm going to request from you, your financials, such as your pay stubs, tax returns, things like that. And I will do a credit pull. So we'll go over your credit score. So credit score is a super important thing, and I know this is a pain point for a lot of people. So your credit score, when we look at it as a lender, is usually somewhat different than what you would see on something like Credit Karma. When we pull it, the algorithm that we use is a much more strict algorithm. So if you had a 680, oops, I'm trying to call. If you had a 680 on Credit Karma, you might only have a 660 when we pull it, something like that. That's just an estimate. But a lot of things affect that total number. So that's, you know, how much do you owe in accounts? Your payment history is always a big one. How long you've had your credit is a big one. And if we need to do any sort of plan to bring you up to where you would be at a qualifying score, we can do that. Even if you're already qualifying, you just want to improve your credit to have a better interest rate, that's also an option. So, and Keneshia and I touched on this before too, the difference between a pre-qualification and a pre-approval. This is a big one. We always talk about this.
Yes.
So pre-qualification is something that I will do, which is basically like a first review. I'm going to pull your credit, like I said, I'm going to look at your income, I'm going to look at your assets, and I'm going to give you a max loan amount of what you can afford based on those numbers. But I am not the gatekeeper. The gatekeeper in this entire situation is the underwriter. And that is the difference between a pre-qualification and a pre-approval. A pre-approval goes through the underwriter, and they have a monstrous list of guidelines and everything like that that they have to double check the file through and make sure that it qualifies. So when you have that stamp of approval, that letter from them saying that you are conditionally approved by an underwriter, it makes the offer that Keneshia submits on your behalf to whatever home you want to buy a much stronger offer, because basically we've gotten all the skeletons in the closet out. We've seen if there's anything that the underwriter is going to not like about your income, or, you know, maybe you have a work from home job. So we have to make sure that we can prove that you are allowed to work anywhere in the country. So you're moving to a different state, any sort of little things like that. We've gotten that stamp of approval, so we know that's not going to hold us up at closing. Or if it would have, we've taken care of it by then. So that's a huge difference, and something that really helps you when you go in front of a seller and put forth an offer. Okay, so we have 4 major types of loans. So we have a conventional loan, an FHA loan, a VA loan, and a USDA. The last 3 are government loans. FHA, VA, and USDA are all government loans. Conventional is kind of considered, I think of it as like the gold star. That's the one that basically any home that you want to put an offer in on will take conventional. It's always either they take everything or cash or conventional. Obviously, if you have, you know, several $100,000 in cash, you don't need me. And Keneshia will have a very easy transaction without you, without being involved. But conventional is the gold star because this one requires a little bit higher credit score. It's a little bit more restrictive in some ways, but it's a better loan overall. You typically get better interest rates and all that good stuff. So that's the one we usually try to put you in if we can. FHA is a type of loan as well that will let your credit score be a little bit lower. It'll let you have a higher debt to income ratio, so you can qualify for more home based on your debts. You can have more debt basically and still qualify. And it's accepted a little less widely. If you're looking at condos, sometimes condos are hard to get in with an FHA loan, things like that. A VA loan is one if you are like our friend Keneshia here and you are current or former military, then that's something that you would qualify for. And then USDA is an interesting one. It's only in specific parts of the country. Now, it is most of the country area-wise, but it's meant for moderate to lower income individuals in rural areas of the country. That's the idea behind it, that it helps you get into the homes that are maybe a little bit harder to get into, that are in the kind of the country parts. So let's keep going here. So down payment. And I want to break 2 things apart that sometimes people put together. When we talk down payment and closing costs, they are not the same terms. So your down payment is a portion of your closing costs, right? So whenever you're paying closing costs, you are paying a down payment, or maybe you're not, depending on the loan type, but it'll have your down payment. our lender fees, things that we charge you to have financing. It'll have your escrows, which are basically just a holding account for your yearly taxes and insurance. So we pay that for you all together. And then the title fees from whatever title company that will review the property and ensure that nobody else has any sort of claim to the home, make sure there's no liens against the house that you end up buying into that you're not aware of. If anything like that existed, title would be on the hook for that and not you. So conventional requires 3% down for a first-time home buyer, not 20. I know a lot of people think you have to put 20% down for a home. That's a thing of the past. That doesn't exist anymore. As a first-time home buyer, it's only 3% down. FHA is only 3.5% down. And then the VA and the USDA loans are 0 down. So you don't have to come to the table with any sort of down payment. You will still have closing costs. It's an important distinction because I know sometimes when people hear about a VA loan, if you're military, you think you don't have to bring any money to closing. And Keneshia may be able to work that out for you that you don't, or I'm able to help her with down payment assistance. But there is a difference again between down payment and closing costs. So even though you don't have a down payment, you may still have closing costs. Okay, so hopefully that makes sense. Minimum credit scores. So on a conventional loan, again, this one's a little bit more strict. So it's a 620 or better. FHA and VA are a 580. We do have specialty products that will let you go under that, but you'll pay for that through your interest rate. So in general, the higher your credit score, the better your interest rate, which we always love because a lower interest rate means lower monthly payment, which we all love. And then a USDA loan is again 620, just like a conventional. Okay. So in the state of Florida, we have something called a Florida Housing Finance Corporation, which gives something called down payment assistance. And these are common in other states as well. I'll just tell you specifically about Florida since we're here. So they have multiple different programs that you can qualify for that give you anywhere between $10,000 minimum and up to 5% of the loan amount. So, you know, if you're buying a sizable home, that could be $20,000, $25,000. The things that you need to qualify for these, you need a little bit better credit. So we were talking about somewhere between 580 and 620 without down payment assistance. With down payment assistance, you need at least a 640. Okay. But the interest rates are very competitive on this. You also will be under certain income caps because obviously, you know, if you're making $300,000 a year, you're not going to get down payment assistance. It's just the way it is. It needs to be reserved for people who actually need it, right? So you're going to have the caps on your income and the caps on your total home costs. So, but they're generous. You know, even for one person, it's close to $100,000. And then the home price is $400,000 to $500,000. So they're very generous. And this is money that we will give you towards your closing costs and down payment, closing costs and down payment. So it's not just for the down payment. That's an important distinction. And this is not, however, a grant. Okay. What that means is this money will have to be repaid at some point. They always refer to it as kind of like a pay it forward program. They will give it to you so that you can get in the home and you can build equity and you can get your foot in the door. But once you sell the home, refinance the home, say you turn it into an investment property, so now it's being rented out as an Airbnb or just a long-term rental, any of those situations would have that money that you took out for down payment assistance to come due. So that's an important distinction. It'll have to be repaid at some point, but it will get you in the home without having to empty your 401k or anything like that, you know. So those are great things, and they edit all, and like I said, they have very competitive interest rates as well. I will say, you know, compared to what you would normally get without it, you actually get a really good rate with most of these programs. So I love that about them. Okay, last couple of things here. While everybody's on their lunch breaks, I'm going to give you a few do's and don'ts of mortgage. Okay. And, you know, these are things that some of them will seem common sense and some of them just won't. So for example, one that may not feel common sense. We, like I said, will ask for bank statements a lot of times because we want to see if you have money for down payment and closing costs. We need to see that it exists. We need to see it in a bank account. We're not looking in the bank account to see where you spend your money. We don't care how many times you've been to Taco Bell this week. It does not matter to us. We are looking at major deposits in your account. So if suddenly you have a $10,000 deposit in your account of cash, we have to know where that came from.
Yeah.
In 99.9999% cases, it's just somebody getting cash. It's somebody that's got cash on their mattress, a relative gave you a gift, things like that. But the reason why we have to know where it came from is because there are illicit funds and fraudulent things that people do and blah, blah, blah. So we all bear the burden for that. So we just have to see where that comes from. So, if you can't prove where a large amount of cash came from, we can't use it. The way around that idea, though, is if it can be in a bank account and we don't see it entering the bank account, we are not going to ask questions. We only ask questions when we can see that it was deposited. So if you give me a bank statement that's already got that money deposited a month ago, maybe we call that it's seasoned a month. Now we don't care. We only care when we see it entering, because then we get, okay, where'd you get this money? Is this fraudulent money? You have to prove where it came from. And if you can't, then we can't use it. So that's one that you may not think of. So anytime you've got money sitting somewhere that's not in a bank account that we can't prove where it came from, we have to make sure we get it into in a way that we can prove it. Okay. Something that is probably a little bit more reasonable that you would think, but it takes all kinds. Do not quit your job. Do not quit your job. Do not, when you do your application, obviously we're going to check your income. We're going to check your credit and all that kind of stuff. And a lot of people think that's where it stops. So once you do that check, now you're free and you're home free and you don't need to think about it. And that is not the case. Once you go under contract and once you're about to close, we will double check that. We will re-pull your credit. We will re-verify that you're still working. And if anything has changed on that credit report, if your job says, no, she quit a week ago, what are you talking about? Big problem, because now the income that you qualify with, you don't have anymore. So do not quit your job, and do not change jobs without consulting with us, because sometimes it's okay. Sometimes it's okay that you're changing job, especially if you're going up in income. Sometimes it's not a good thing though, especially if your job is one that's dependent on, say, a lot of variable income, like bonuses. If you're fully commissioned, something like if you're a realtor and you're 100% commission and you quit that job and go somewhere else, obviously now your income starts all over. We don't know what's common for you, so we can't accept it. So just keep us in mind. Usually it's just a 2-year history that we need to see. If you're just switching from one job to the other and your W-2 salary, that's usually not a problem. But if we're dependent on that overtime income to get to the sales price that we want to get to, if we're dependent on bonuses that you're used to getting every year that we're using to make sure that you have enough income and you quit that job, that type of income we cannot use anymore. We have to have a 2-year history of anything variable. Okay. And another thing that people will do sometimes is they get their credit pulled and then they go buy a bunch of furniture for their new house, which is not illogical. But once we re-pull the credit, if we have a new $1,000 a month credit card on there that now we have to account for, you may not qualify anymore. So any of these purchases have to wait until after you purchase the home, after everything is closed. That way, nothing that you do there is going to affect your ability to qualify. So you basically go into a holding pattern once you've gone into your pre-qual. Not that you can't do anything, but we need to discuss it first, because if your numbers are tight or anything like that, we don't want to push over by something that could have waited. So I hope that those are the don'ts. So do be ready to have your credit pulled. Obviously, we're going to pull your credit. We can do soft pulls initially so it doesn't hurt your credit. You only have to do a hard pull once we know we're going into underwriting, like say you're under contract or we want to go ahead and have everything approved. Do be ready to give us pay stubs, give us W-2s, give us tax returns. We need to know if you haven't filed your tax return in the last 2 years. That could be an issue. We need to know that. And your bank statements. Sometimes people get gifts for their down payment and closing costs. It's really common. We need to know that so that we know where that money's coming from, so that we don't have them deposit in your account. We can usually just have them send that money directly to the lawyer, to the title agency. And it's super important that you make all of your monthly payments on time, especially if you already have a mortgage. A mortgage late is a huge red flag in an application. If we see a mortgage late, that could be something that disqualifies you right there. And then just for your regular credit card payments, you got to pay stuff on time. And that does not mean paying a couple days late. It was due on the 1st and you paid it on the 5th. That's okay. That's not going to report to your credit. If it was due on the 1st and you pay it 45 days later, that is a problem because that's over 30 days late and that will report. But just like maybe you incurred a late fee or whatever, that's fine as long as you pay it in less than 30 days and it won't report. And like Keneshia said earlier, make sure your names are spelled correctly on everything. It's a crazy thing, but it does happen. And if your name is spelled one way on one thing and one thing on another, or you have your maiden name on one thing and your married name on another, that can be an issue. So just make sure your name is spelled correctly. That seems pretty straightforward, right? And yeah, I think that is most everything there. Let's see, Keneshia, do you see any questions on our end anywhere?
No, I don't see anything.
No, nothing right now. Okay, and I don't see anything on my end here. Okay, so what we're gonna do then is pop our information up here and let you guys know. We know that this is a sensitive topic too, that you don't want to discuss your finances and stuff over Zoom and over a live.
Right.
So feel free to reach out to either of us via Facebook, via phone, email, whatever works for you. And we are happy to go over the ins and outs of what you personally might need to qualify, get you together with a credit plan, whatever the case may be.
Exactly.
Yeah.
Yeah,
Yeah.
good class, great class, I should say, great class. This information is a wealth of information.
It's a lot. Yeah.
It is, and hopefully it's not overwhelming people because, like I said, I want this process to be as easy and as smooth and happy as
Right.
possibly, and it's possible. I know it's possible.
Mm-hmm.
I've worked with you, Carly, and
Mm-hmm.
I love the way that we work together, and
Yeah.
it's smooth. It's smooth from
Teamwork.
start. Yeah, teamwork is
It's a team
is
process.
yes, that's the
Mm-hmm.
process. And so I like your energy with helping the clients get to this
Yeah.
closing table and informing them with the information that they need for their situation. You don't
Right.
group them all into this one pot and
Yeah.
say, hey, I'm gonna help you with this and help you with that. No, you listen to them and you see exactly what their needs are. And I
Right.
appreciate that. Yeah, Carly.
Yeah, of
Yeah,
course. Of
that makes
course.
a difference.
And
Yes,
Keneshia knows what she's doing in this market. So she knows how to get you that seller credit if they're able to do it. She knows how to get those
exactly.
repairs negotiated into that contract. So you dealing with somebody, if you were thinking about doing this on your own without a realtor, I just
Mm.
urge you to reconsider.
Reconsider, guys, because I don't want
Reconsider.
anybody out here tossing you around like a Raggedy Ann
Because they
doll.
will.
Yeah, they will.
Unfortunately, if you don't know what
Unfortunately.
you're doing, and you have to remember this is the biggest purchase you will probably ever make. You need somebody that knows what they're doing because you'll just get taken advantage of. I hate that it's like
Exactly.
that, but it's just
But and that's
it's
in
what it
every
is.
industry though. So
It's
I like to let people know that like I think real estate get this bad stigma because there are bad people, but there's bad people everywhere, you
right,
know? So it's just to do your own homework. Carly and I are showing you that we're here
right,
to help take down those stress or those doubts that you
hmm
may have about
right.
things in this industry or whatever, or people in this industry. Because I have a family, Carly has a family, and I love to sleep very good at night. So so
Yeah,
we're not
yeah,
gonna be here bull crapping you. We're gonna take our time with you and help you through this process, guys. So if you find this to be helpful, leave us a comment.
yeah,
We're gonna be here again next week, 12
right,
p.m. lunchtime. Grab yourself a sandwich, uh,
right. Sit
get your
down,
lunch, and let's sit here. Let's chat. We're hoping that you guys come on here with some questions for us,
right,
and we can just discuss those questions that you have and debunk those pain points and myths that you may be having. Okay.
right. Okay, guys. Well, with no more questions, we will leave this
End
one for the
this.
day
Yeah.
and just reach out if there's anything we can do to help you guys.
Yeah. Till next week, guys.
Till
See
next
y'all
week,
next week.
next Friday. Tell everybody you
Next
know.
Friday.
Bye.
All right. Nice seeing you again, Carly.
Love. Bye.
All right. Bye-bye.